Hello there. In this section, I'd like to go over in very simple terms how put options work. The wonderful thing about options is it's just as easy for you to make money when a stock is going down as when a stock is going up. Options give you that versatility. Now, a put option is simply just the right for you to sell a stock at a specific price before a specific date in the future. That's all it is, plain and simple. It's just the opposite of a call. With a call option, you have the right to buy the stock at the strike price. With a put, you have the right to sell the stock at the strike price. Now, just to further clarify the concept, I want to give you a real-life example of a put option. It'll make you understand it in very simple terms. Then I'll give you a stock example. And by the end of this short video, you'll understand how put options work. Let's say, for example, you own a home and its current value is around $300,000. But your employer tells you that you're going to be relocated in 6 months. So you need to sell your house, but you need a place to live now, but you'd like to sell it in 6 months. So what you do is you go out there and you find an investor and you tell them, hey, listen, I want to sell you my home for its current value, $300,000, and I want the option to sell it to you anytime between now and the next 6 months, and I'm going to pay you $10,000 for the option for me to sell it to you for $300,000. Now the real estate investor goes, well, I think the value of your home may go up, so yeah, I'll take your $10,000, and I'll be obligated to buy your home at $300,000 between now and the next 6 months. So let's go over two different scenarios. Say 6 months down the road, the value of real estate in your area skyrockets and your home goes from $300,000 up to $400,000. Well, you won't want to exercise your options contract. It's not worth it for you to do so because you can sell your house in the open market for $400,000. So you're going to let your options contract, your put options contract to sell at the strike price, which is $300,000 to this investor. You're going to let that contract expire worthless. Yes, you're going to lose the $10,000 premium that you paid for that put, but you're going to be able to sell your house for $400,000 in the open market, and you're still going to make money. So it's okay. So that's one scenario if the home values go up. Another scenario is if the home values decline in your area. Say the value of your home goes from $300,000 down to $200,000. Well, in that particular case, then you want to exercise your option to sell the home to this investor for $300,000. He's not going to like it, this investor, buying your home for $300,000 because the house is worth a lot less now, but he has to buy it from you. He's obligated to buy it under the contract specifications. So you sell the home to him for $300,000, and you did pay $10,000 for the right. So it's like you sell the house for $290,000, even though it's worth a lot less. Say it's worth $200,000, you can still sell it for $290,000 under the contract specification. So that's basically a put option in real life terms. Now it works exactly the same in the stock market. Basically, you have the right to sell a stock at a specific price. Say, for example, you see a stock out there and it's trading for $40 per share and you think it's going to go down. You can buy an options contract to sell the stock at $40 per share between now and a specific date in the future. Now, if you think it's going to go down within a couple months, you can buy a put option to sell it for $40 per share. $40 would be the strike price between now and the next couple months. Now you can buy more time, it's going to cost you more, but you only want to purchase as much time as you need, because the more time that you have, the more money that the option will cost you, the more premium it would cost. So say, for example, this particular stock goes from $40 per share down to $30 per share. Well, you have the right to sell it for $40, okay? So you could sell it for $40, and you could buy it back immediately for $30 per share if you were to exercise the contract. And you would make $8 profit per share, or $800 per contract, because from 40 down to 30, that comes out to 10, but you got to minus out the premium that you paid for the contract, which is $2 per share for the options contract. Now, each options contract controls 100 shares of stock. So if you bought one contract, that would allow you to sell 100 shares of that particular stock at $40 per share. So, in that particular case, you can make a pretty tidy return. That's like a 400% return if the stock goes down 25%. That's not too shabby. Whereas the worst case scenario is if you're totally wrong and the stock ends up going up, say it goes up, above $40 per share, above the strike price, and stays above that until it expires, then the options contract will expire worthless and you'll lose the $200 premium. So there is some risk involved, of course, when you trade in put options. But you can put up a lot less money than shorting a stock, and you actually have limited liability with a put. You can't lose more than that $200, whereas if you short a stock, technically your liability is unlimited. I mean, technically the stock can go up to infinity and you could lose an infinite amount of money. But with that put, you have limited liability. So that's put options investing in a nutshell. Hope you enjoyed this section of the presentation. Thank you.